Good afternoon and welcome to FESE webinar, How Does the Market Structure Link to Pensions, which is taking place as a part of the very first European Retirement Week. European Retirement Week was launched earlier this year by 11 European associations, of which FESE is the one. Its goal is to provide platform for a wide range of stakeholders to debate the future of pensions in Europe and, crucially, to raise citizens' awareness of the need to save and invest for retirement. Advances in medicine and greater education about healthy living means we in Europe are living longer. Inevitably, therefore, as we grow older, the working age population as an overall share of Europe's population is decreasing. Combined with relatively low birth rates, this means public pension in Europe, same as much of the Northern Hemisphere, are coming under increasing pressure. Exchanges help to mitigate of these effects by its primary market activities, by bringing new listings to the European markets into which pension funds can invest. Building an ambitious and effective CMU is more important than ever. At yesterday's opening event, we heard Commissioner McGuinness about the ways in which the Commission is attempting to increase access for retail investors to the public markets, a core objective of the Capital Market Union. We welcome forthcoming initiatives to improve financial literacy among adults and children and look forward to engaging with the proposals for the pan-European pension product. We also hope the EU strategy for retail investors ensures improved market outcomes, empowers retail investors, and enhances their participation in the capital markets. However, major barriers to the active participation of retail investors remain. Simple, comparable, and cost-effective products must be made more easily accessible across the EU. Coupled with this, Europe's need a fair and efficient trading landscape, something which will not be delivered just by the famous consolidated tape. Core elements of the recently published MiFIR review proposal unfortunately seems to miss the moment, failing to meet the objectives of increasing transparency and liquidity, ensuring a level playing field between execution venues, and boosting competitiveness. Today's webinar will assess these matters and other key questions in the context of what we need to mobilize saving in and to bridge the Europe's pension gap. We encourage the policymakers to be ambitious and develop a strategic approach towards European capital markets to support the recovery, to empower all investors, including retail investors, and to deliver sustainable growth in a transparent trading landscape. We need more our fellow European citizens to be invested in European equities, as it will be profitable for all of us, for the issuers, for the investors, and for our democracies. And with that, I'm pleased to introduce Rosa Armesto, Deputy Director General of FESE, whose keynote speech will, I'm sure, expand on some of these themes, as well as identify potential solutions to the challenges facing European pension systems. Rosa, the floor is yours.
Thank you very much, Peter. And once again, welcome everyone to our webinar, How Does Market Structure Link to Pension Returns? My name is Rosa Armesto, Deputy Director General of the Federation of European Securities Exchanges. I am delighted to address you on why market structure matters to ensure that citizens get the best deals for their savings and investments. Considering the demographic challenges faced by most EU countries, state budgets will come under more and more pressure in the future to pay out an adequate replacement income at the moment of retirement. Increasing life expectancy and so a longer retirement is something we should all welcome. It is a marker of Europe's progress. However, in response to demographic aging, many European countries have been reforming their public pension systems. Often, though, these reforms have focused on short-term measures rather than structural shifts. With amplified pressure on public budgets, it is increasingly evident that investments in Pillar 2 and 3, that means occupational and private or individual pensions, will be needed to maintain dignity and comfort in retirement for younger generations. Exchanges support realizing the benefits that Pillars 2 and 3 could bring. In fact, exchanges contribute to improving retail investors' access to products for their long-term savings, create trust, and establish a safe and transparent trading ecosystem with reliable prices. Through their transparent price formation process, exchanges also contribute to the overall Capital Markets Union objective to make the EU an even safer place for individuals to save and invest for the long term. And yet, while in particular Pillar 3 has become more important, most long-term and pension-saving products have not, on average, delivered anything close to those returns from capital markets. Indeed, in too many cases, these products even destroy the real value for European pension savers, as Better Finance shows in its 2021 report. This report finds that the main reason for this is the fees and commissions charged to retail customers. Citizens are too often only offered expensive packaged products by intermediaries, rather than direct investments without management fees. To incentivize active retail participation for financial planning, simple and cost-efficient products must be easily accessible across the EU. But contrary to the objectives of the CMU to increase retail investor participation, important barriers to access remain. I would now like to expand a bit on access to products. Indeed, access to certain simple products remain limited due to some regulatory requirements. Some requirements, like the PRIPS key information document, are not suitable for all products. Its design might leave some simple products out of reach for retail investors. Other regulatory shortcomings may obstruct the creation of the pan-European personal pension product, known as the PEP. For example, divergent taxation rules, legislative barriers, and legal requirements across member states are obstacles to cross-border investments. It is necessary to foster access for pension savers to these products, like the PEP proposal and other pension funds. Other financial incentives, such as tax breaks and employee share ownership, should also be promoted to foster an equity culture in Europe. Access is currently also limited by the existing categorization of investors to two different groups of professional and non-professional investors, creating a barrier to retail investors with a higher level of knowledge. This is why, at FESE, we support the introduction of a semi-professional category, so as to enable those retail investors to access products currently out of their reach. While access to products may be facilitated on a structural level, many studies have shown that investor participation goes together with the level of financial literacy. As Commissioner McGuinness mentioned yesterday in her opening speech, to ensure that retail investors can make informed decisions, efforts to improve financial education and to empower retail investors should be pushed. To benefit from those improvements, we can't deny that it is crucial to have a fair and efficient trading landscape. The EU needs a market architecture that funds the economy most inclusively and fairly for all investors. Barriers remain to a fully efficient equity market structure. We can't ignore the low levels of transparency and some conflicts of interest. However, the MiFIR review proposal published last week as part of the CMU package seems like one step forward, one step back. While some aspects are a step in the right direction to further integrate capital markets, other core elements don't meet the objectives of increasing transparency and liquidity. Unfortunately, this proposal is a missed opportunity to improve transparent trading. It lacks a clear vision for how to strengthen the fairness, integrity, and transparency of European markets. It also fails to address how the EU can increase its competitiveness to the benefit of issuers and investors. So, let me briefly address market structure specifically. I will start defining price formation. Price formation is the process that determines the price of a security once the interest of both the buyer and the seller have been factored in. There are multiple benefits attached to it. Above all, efficiency, fairness, and lower cost of capital. Transparency is the prerequisite of price formation. However, transparent trading has decreased since the implementation of MiFID I. MiFID II was intended to be more transparency to European markets, but trading on dark venues, which are reference price takers, has increased, accounting for about half of Europe's trading, according to data from ESMA. In particular, the market share of systematic internalizers exploded with the implementation of MiFID II. Investment banks run their own systematic internalizers, which generates a conflict of interest as they have their own financial position on the same instruments. Systematic internalizers make profits from earning the spreads, while depending on reliable prices provided by exchanges. The majority of systematic internalizers' volumes are not pre-trade transparent. But is this concerning? Yes, it is, because internalizing a small order flow is harmful to the quality of trading due to the deterioration of price formation process. Small trades do not have market impact, so to be waived from transparency. This is why it is crucial to ensure high levels of transparency in the trading landscape. Considering these aspects, FESE regrets to see that some elements of the MiFIR reform do not match up to its stated objectives. EU policymakers must set a clear direction for Europe in terms of the relative market share of transparent trading versus dark trading. Moving on to another aspect, the predominance of systematic internalized trading is not the only factor adding to conflict of interest and promotion of dark trading. This year, the new retail order flow trading model, known as payment for order flow, has grown in importance, notably following the GameStop volatility in the US. Payment for order flow is a business model that is often applied by commission-free online brokers. How this works is that a broker routes the retail order flow it receives to a single market maker, in most cases a systematic internalizer, in return for a payment. This type of order flow may generate conflicts of interest, as brokers are incentivized to route orders to buyers offering the highest payment, rather than trading venues offering transparency. This practice also leads to a deterioration of price formation. So, while payment for order flow may imply lower explicit trading cost, it doesn't mean that retail investors are obtaining the best possible execution quality. Essentially, retail investors may, without knowing, not receive the best deal from their perspective. This is why we very much welcome the recent Commission proposal to ban such practices in MiFID II. However, it seems illogical to ban payment for order flow while at the same time continuing to allow execution venues to internalize retail flow. If not corrected, end investors will continue to pay the bill of an ill-designed market structure. In conclusion, FESE feels the MiFIR review as proposed is a missed opportunity. We hope that co-legislators give further consideration to how to increase transparent trading and protect price formation. But we also hope that the EU strategy for retail investors ensures improved market outcomes, empowers retail investors, and enhances their participation in capital markets. As we have seen, there is a high degree of interlinkage between all pieces of legislation, but while the challenges hampering the success of the Capital Markets Union are complex, they are entirely fixable, and the EU can do so in a way that benefits all market participants. Exchanges stand for an efficient equity market structure, which is crucial to increasing investor participation and access to simple products. The right reforms will ensure a fairer and a more inclusive economy for workers and pensioners. Thank you very much for your attention. I will now give the floor to Rainer Ries, Director General of FESE, who will introduce our panel discussion.
Thank you so much, Rosa, and I think you did a very excellent job of setting the scene for our panel discussion towards a European market structure that delivers for investors. And I think the points you raised, how can Europe encourage retail investors to better invest for their retirement, and pointing out the demographic challenges for democracy, etc. I think that is something I hope we'll touch a little bit on. But what should public authorities do through the Capital Market Union to facilitate greater access? How can retail investors have better access to execution venues? You highlighted that. How can we ensure appropriate investor protection and bolster best execution, protecting the end investors against payment for order flow and internalization? I think those are the key questions. I have an excellent panel to discuss this with and maybe we can bring them on. So I am introducing Sebastian. I'm going in reverse alphabetical order because I just learned Christiane is having some connection issues and is dialing in again. So let me start with Sebastian Raspaillier. He's head of financial sector directorate at the French Treasury, and then Anthony Attia, global head of primary markets and post-trade Euronext and vice president of FESE. And then hopefully Christiane, she is just connecting again. She is managing director of the Deutsche Schutzvereinigung für Wertpapierbesitz. I'm German, so I can say that, pronounce it correctly, which is Germany's leading association for private investors and also a member to Better Finance. We were also expecting the Commission to join, and Alexander de Schroeder, Deputy Director General of DG FISMA, had accepted to join us, but she had to cancel due to other commitments, short notice. And I think given they just announced the MiFIR review proposal, we obviously know what is in there. So that's maybe the good thing, but obviously it would have been interesting to hear from them also their views, why they chose the path to make their proposal in the way they did. But well, I think there will be other opportunities, and having such a competent panel, I'm sure will be able to shed a lot of light on European market structure that delivers on for investors. With that said as an introduction, I would probably ask Christiane to open a bit. I think Rosa was describing a bit how Europe can encourage retail investors to better invest for retirement and what the challenges are. And I know you've done a lot of work on this, so maybe you want to start and begin with this.
Yes, Rainer, thank you very much for having me today, and for even more for allowing me to set in the scene. And let me start by saying that I think we need nothing less than a paradigm shift for the future of retirement savings. What we see currently is that real returns of long-term investment and pension products, I mean the returns after fee and adjusted to inflation, perform really poorly. You said you referred to Better Finance, the European Federation of Investors and Financial Services Users, and they annually research the real return of long-term and pension savings. And the latest report again found that despite bullish markets we saw recently, most of the products they analyzed, the pension products they analyzed, barely covered inflation, and only very few came close to the performance of a simple, broad European capital markets benchmark. So that is devastating. And of course, the question is, what are the reasons for these results? There's, on the one hand, we see always high investments of pension products in bonds, many of which, what we all know, currently provide negative yields. We see a high level of fees, which is eroding net returns. And we see, of course, a lack of transparency on fees, which makes it really difficult for pension savers to compare between different products and product providers. And of course, let's not forget inflation, which alone destroys a significant part of savings, especially over the long term. But I'm not here to complain all the time. The good news is that there are many opportunities to tackle these problems. Looking at the pension systems, we need really to embed equity products in the EU state pension systems. Sweden's AP7 pension fund that's the example everyone is referring to, and also for me, it's an excellent example on how to achieve this. And I was very happy to see that in Germany, our new government has decided to somewhat follow the Swedish model and to shift our pension system from a poorly pay-as-you-go scheme to a scheme that is partially equity funded. And I think it is really high time to do so. We need tax incentives to foster long-term investing in the third pillar and to strengthen the second pillar. Here, you can look at the US with their 401k concept or the Canadian tax-free savings accounts. All these could serve as good examples also for Europe. And of course, we need to strengthen employee share ownership, which I consider is key for the success of the CMU, because it leads to an increased long-term engagement of employee shareholders, which have a strong focus on sustainability, and it will improve the corporate governance of companies they are invested in. And most importantly, we need to review the retail investor protection framework, because what we all want is a CMU that works for people. That was the claim we started with in 2015. And currently it doesn't. Individual investors are rarely advised into direct investments like low-cost ETFs or listed equities or bonds, mainly because they do not generate sales for the so-called advisors, unlike packaged products. We need true bias-free advice in order to enhance the share of low-cost investment products, and we need to improve pre- and post-trade transparency for investors. On the one hand, we can do this through more comparable pre-contractual information, like the KID, for example, but also the consolidated tape. And I think we will talk about this in a minute, a bit more in depth, will play a role, or can play at least a role here. So, in my view, to conclude the first part, it is high time to ensure that individual investors and pension savers get value for the money they invest. And what do I mean with value for money? That's very simple. Savers and investors should get back at the very least what they saved year after all fees paid, and in real terms, meaning after cost and after inflation. The purchasing power of their lifetime savings, this is what the minimum should be. And to bring it a bit more flesh to the bone, value for money for me means that at a minimum, long-term and pension products must provide for a full cost and performance disclosure comparable to similar investment products. So it cannot make a difference if I have a wrapped ETF life insurance complex product or an ETF. I must have the same disclosure, and the costs must be proportionate to the investment objective and other comparable retail solutions in the market. And last but not least, savers must be informed regularly how the product delivered value for money for its beneficiaries. So there must be transparency also in that respect. And this is, of course, nothing I have invented, because such a concept already exists in the UK. And EIOPA is assessing this concept for certain products already too. So it is worth, in my view, that also the EU Commission looks into the value for money concept. And I will stop here and hope that was a little bit of food for thought.
Maybe Sebastian, can I suggest that you take over in the absence of our moderator?
Moderator, no, sure. No, so thank you, Christian, for this meaningful insights. Just some words regarding possible priorities for the upcoming French presidency of the Council of the European Union. In this field, as you have mentioned, Commission has tabled many texts in the field of capital markets union last week, and is planned to deliver a retail investment strategy first half of 2022. I mean, just one first political thinking. The European Union has committed to digital and green transition, and especially climate carbon neutrality in 2050. We all know that this will require huge investments. And the current situation is that we are lacking of investment. So if you add the additional investment that we will need to an unsatisfying situation currently without this need, you see that there is a huge gap to fill. The good news, is that the European Union is the jurisdiction throughout the world which can rely on the biggest pot of savings. So normally, we should be in a position where we should feel more comfortable than others. That's not really the case, because we have a huge pot of savings, but currently we see that it would be very difficult to channel it towards the achievement of these two most important goals of the European Union. So this will require a political will based on a political narrative, something that has probably lacked in order to push the Capital Markets Union initiative. So maybe we finally got it right now, still to be worked on, but it can be promising. Second, we won't do at the place of savers, so we need them to be on board voluntarily, of course. We need for this to help them. That means all the sustainable finance agenda is very important, but it has to be done in an efficient way. All the protection, investors protection agenda is key, but here in this field, it's probably not about adding other layers of information that no one reads. So on the contrary, it would be meaningless. So maybe kind of a reboot. Of course, the issue of value for money is important, but that's a slogan. And we should avoid to keep it as it is. I see the no shaking, but what I'm saying is that we won't be able to achieve our goals if we exclude many people from participating from that. Just one current fact. We see many people investing their money in bank accounts, giving no money. They want security of their capital, they want liquidity. On the other hand, we see young people not using exchanges, not using intermediaries, using applications, wanting to be retired before they're 40 and going to crypto assets. So we have to deal with that also. What that means is that you have some people wanting to take risk, and that's a good thing. We should be able to allow them, and maybe a little bit less risk, a little bit less reward, but still better than just blocking their money on bank accounts. So there is quite an agenda to have on that holistic approach. So we expect much from the retail investment strategy by the Commission. But again, if we just take hours, days, weeks to discuss the same topics as for the past 20 years, we will achieve maybe something, but not everything we need regarding the incredible speed of evolvement of behaviors when you see young people, even not that young people, savers, and so on. So yeah, pension in that regard are quite important. It's up still to member states to decide on their retirement schemes. I'm not sure that they will develop much private regimes based on savings. Still, they will develop it a little bit, but maybe not that much as compared to the US. So we also need to think of all the other medium to long-term pots of savings, even if not as efficient as pension funds for being able to invest, for instance, in unlisted assets or infrastructure of humanities. LTIF is a very interesting opportunity. We will try to push it during our presidency within the Council. Solvency II revision is, of course, very important when you see the big amount of money that insurers are managing. And also all the rules regarding, for instance, MiFID. I mean, in France, 2 years ago, we had the privatization of our national lottery. And you had so many people prevented by their banks to invest in that due to respecting MiFID rules. If you think of an investment that was not that risky and which has delivered a high return, that was quite an example. So, I mean, just to say that we will be, of course, honest brokers, we'll do our best to make progress towards consent on all these texts that the Commission has tabled. But I think that we need to keep a guideline, a general guideline, if we don't want to get into the technical trap. I mean, going into silos, revising text by text, losing the big picture, losing the end goal that we want to achieve commonly. That means having more capital oriented towards green digital transition, oriented towards European growth. If we want to avoid this technical trap, then it's very useful to have kind of a holistic approach on every topic that enable people to go and to have more confidence onto markets. Here on that means having in the end KPIs, and the Commission has proposed some, but to monitor progress. And the first KPI, in my view, should be to bring more capital by more people. We really want to avoid kind of a political issue in the end if we just rely on only the wealthy people. And there are possibilities to the possible extent, keeping them safe, keeping them protected, but to have more savers on board in a smooth way, making them understand also that it's useful, general manner to invest in European future. So that would be kind of general thinking, very broad, but if we can apply it to each negotiation, that could help to have a satisfying result in that regard. That would be at least one objective for the French presidency. Thank you.
Thank you, Sebastian. And you said one word which was extremely pertinent, and that was reboot. When I rebooted my headset, I finally was able to join again. But I think thank you to Christiane, and thank you for you picking up with my short interruption. And maybe, Anthony, with that, I'd give you the floor. I mean, I heard from Christiane, I think the concerns about value for money and that the current system doesn't really deliver. And I have to say, when I'm looking a little bit at my friends and family, what to recommend to them to save for old age, it's a difficult question. And I think, when I hear a little bit the returns that current products generate, when I see the fees that are being charged, that is a difficult thing. We heard from Sebastian the need to obviously go into digital and sustainable transformation and make the capital available. And I think this is a question for Europe as a whole. And Sebastian rightly said, political will is needed. But maybe, Anthony, the capital market union, to get it functioning, what is the perspective from exchanges? What can we do? What must we do in order to achieve, I think, the political challenges Sebastian outlined, and square that a little bit with the investor view that we heard from Christiane?
Thank you, Rainer, and good afternoon, everyone. And it's a pleasure to be in this panel together with Christiane and Sebastian. I'll share with you some comment from a market practitioner and the point of view of the exchanges. Maybe starting with a few elements that are positive despite everything we said. The share of retail investors that have been buying and selling listed equities in the past couple of years have significantly increased. Sébastien mentioned in France the kind of trigger event, which was the privatization of the French betting company, La Française des Jeux. It was a real kind of a trigger event to reconnect with retail investors, and we saw them participating in a significant manner. And it was not just a one-off event. It restarted a trend, and obviously when we worked on this privatization operation, we really saw the hurdle and the barriers that MiFID created for the distribution of very simple, I would say less risky, and for sure less risky than digital assets products that are listed shares. And so we had to overcome some of these hurdles, but the operation went well. And since then we enjoy roughly 4% of the total investors on our markets at Euronext, and we represent roughly 25% of the secondary market activity in Europe. 4% of this activity is linked to retail. So this is almost it's 30+% more than before. During the COVID moment, it went up to 6%. So we see that there is a digitalization as a direct impact. We also see that trend in the oversubscription rate of IPOs, in particular in France, but not only in France, where some flagship operations show that retailers really want to be part of new listings. Some of these operations can be oversubscribed, sometimes 20 times, 30 times, 40 times. So it is significant. And another trend that verifies systematically is when these IPOs show long-term meaning are related to ESG, retails come more often. And so this is fascinating. Now we also observe similar trends in the Nordics, where Euronext has central securities depositories with segregated accounts. So we see directly the number of new retail accounts being opened and the activity of these retails in Norway and in Denmark, and it follows the same trend. It's back. Now, what we hear from these retail investors and from the intermediaries that work with them is that we still have some complexity and barriers that have been commented by Sébastien and by Christina, but it's all about the value for money for sure. It's about fairness. I mean, why would we have so many constraints to invest on listed regulated markets and no constraint to invest on cryptocurrencies? It makes no sense, right? And so I completely subscribe to what Sébastien said. We need guidelines. We need a clear approach at European level to fix these discrepancies. And the last thing we need is additional complexity. And so some comments about the market structure. So we believe at FESE and at Euronext that it is critical that EU is equipped with a strong vision of development of European public capital markets, because it has a direct consequence in terms of economic growth, both within European Union, but also to compete globally. We're not in a closed market for sure. And so we believe that the market structure initiative, and in particular the CMU package, should strengthen European capital markets and not add complexity or not add hurdles for the different operators, in particular post-Brexit. But the subject that is very dear to me is the access of small and mid caps to capital markets, and finding a place where investors can meet with issuers, with projects, ensuring European companies, that the large and small one, can raise financing on an efficient basis from public capital markets should always be in our head when we negotiate new future regulations. A lot of people talk about it, but in effect, we don't see it happening as significantly as we would like to. And so, concerning the CMU package that was launched by the Commission on November 25th, so it's very recent. The proposals are to strengthen the market structure, the transparency, and the reporting for listed company. FESE has published a very clear position, and I will relate, and I think Rosa commented it as well before this panel. We believe that these proposals are underwhelming, and we don't believe they will achieve the intended objective, and we believe we should have a transparent and inclusive market with access to EU retail investors that need to have confidence in financial markets and take control of their financing, of their financial planning. In particular, the MiFIR proposal does not address the concern that have been widely shared with respect to trading on transparent markets. The MiFID package is core to the organization of the pan-European securities market because it's supposed to provide access for investors to investment opportunities. So we do welcome the proposal to introduce a ban on payment for order flow. Again, it's about fairness, and it's about transparency, and it's about value for money. But this ban on payment for order flow should contribute to best execution for retail investors across the EU. But we do regret that the proposal focuses on the consolidated tape initiative with a limited amount of measures to address pre- and post-trade transparency when trading securities. And as such, it's our view that the proposal only scratches the surface when it comes to market structure issues. Again, probably it looks good from a far distance, but when we look at the details and the implementation, it doesn't serve retails, it doesn't serve institutional investors, it only serves a few. And so we remain convinced that in order to achieve this transparent market structure for all investors, further attention needs to be paid to simplifying market models that support price formation. The proposal to include pre-trade data in a real-time consolidated tape will not support this goal, and on the contrary, it will inevitably lead to an arbitrage opportunities. This is because the inclusion of pre-trade data in the consolidated tape will lead to the emergence of a flowed reference price. And this reference price provided by the tape will be flowed due to two factors. One is the dispersion of trading venues from a geographical basis. And market participants in Europe, we are by definition spread in a large geographical footprint. It means that each trader will have a specific view of the reference price depending on their physical location. Makes no sense to us. And the second factor is the fact that some market participants will inevitably get pre-trade data faster than the tape due to superior technologies and different level of investment being channeled into network infrastructure. We need to learn from the mistakes made in the US. And not copy them 10 years after they happened. Arbitrage becomes possible in such a scenario because market participants may guarantee execution at the tape reference price for retail investors, while they themselves will be able to trade at a better price at the expense of retail investors. This is what market structure is about. A post-trade tape, however, should cover 100% of data sources and carry post-trade data together with information on liquidity available at execution. It would enable market participants to assess fragmentation and available liquidity across venues, as well as to support execution analysis, allowing investors to validate the execution provided by their brokers. It would constitute a distinct offering and would not burden market participants with a duplicative cost. And again, this may seem as technicalities, but it's fundamental. It's fundamental because, again, if at every attempt to simplify regulation, we end up with more complexity, with more centralized view from the market in Brussels, it will never serve the end investors, and particularly not the retails. So this concludes my preliminary remark, Rainer. And you are on mute.
And you perfectly, thank you very much. And you perfectly gave, I think, the intro to, I think, the core we want to discuss. How does really investor returns for retirement link to market structure? And thank you for that. And probably makes me turn to Christiane initially, because if I look a little bit what Anthony just described, it is a market where, as a retail investor, and I speak for myself, I can log on to my brokers, and because I have a professional interest, I have quite a lot of brokerage accounts. And Germany is a market where I think there is a bit of domestic competition between certain execution venues. So in Germany, with most banks, I have a bit of choice, but many of these venues that I deal with professionally, CBOE, Equus, Goldman Sachs SI, Morgan Stanley SI, etc., I can never interact. And I sort of question myself, as a retail investor, what is really market structure? And we heard from Rosa how important price formation is. What is really the retail investor view to market structure, and how would you like to see, I think, market structure being improved? What is sort of your expectation to a MiFIR review?
Thank you, Rainer. My view on market structure is that market structures are currently very much distorted and do not best deliver for retail investors. What we see is, there we base our analysis on studies, for example, commissioned by FESE, that half of the trading, including the retail trading, is taking place on dark venues. And you said that you named CBOE and other operators. These are fully unknown to retail investors, to most retail investors at least. I mean, you are already a very professional retail investor, so to speak. But if you think of the normal, ordinary investor who is not trading heavily, but just wants to a certain amount over time, such an investor does not know that there are other venues, and on top, such venues are less transparent and much less user-friendly towards non-professional investors than the EU-based regulated markets. Petr Finance has done a study on that as well, and they found that access is not very easy for the regular retail investor. So to ensure that investors enjoy optimal outcomes, how can I say? In my view, it is important that we need an adequate price discovery and formation mechanism, which, and this I'm convinced, can only be ensured by lit trading of retail orders. And this enhancing lit trading for me is really key. And in my view, the review of MiFIR should have focused on this first before dealing with other things. And also, in my view, when I have venues that are doing business with individual investors, they should be required to comply with the same best execution and transparency requirements. So the fair, clear, and not misleading information rule, the rule of acting in the best interest of client, must also apply to those operators, be it systematic internalizers or others. And then we see the MiFIR review having focused on the consolidated tape. Yeah, the consolidated tape can indeed play a role, but it needs to be well designed. In any case, it needs to enable individual investors to easily access post-trade data in order to evaluate really best execution of their orders. This is what they cannot do today. And it is crucial that there is fair and cheap access to the data for all, and not only for certain market participants. I'm not sure if the consolidated tape in the design that is proposed by the EU Commission will achieve this goal. For me, this remains to be seen. For example, I do not yet see that the Commission's CT proposal addresses market structure deficiencies. The markets are too complex, too fragmented, and too intransparent. And in my view, these problems need to be addressed first before hazarding such a huge and costly experiment with unknown outcome. And on top, looking at the proposal from the Commission, I still have a hard time to see where the benefits of a pre-trade trade, which has not been fully ruled out by the Commission, would be for individual investors. I will stop here for now.
You have to unmute right now.
Today always on mute. Thank you, Christiane. That brings me to Sebastian. If I hear a little bit from Christiane, I think the issues that end investors face in trying to access market, not being able to verify whether they did receive best execution, not really knowing payment for order flow, where they're being internalized, who's making money off their order flow. And if I hear a little bit the call from Anthony to have, I think, more holistic vision in the MIFIR proposal that would address those deficiencies in market structure, that brings me ultimately probably to the question, is Europe doing the right thing? And in the US, we have, in a much larger market, 40 to 50 execution venues that compete with each other. In Europe, in equity trading alone, we have 250 altogether. We now have 600, and the Commission in the MIFIR proposal says, okay, this is a great competition we need to foster for the benefit of investors. There's a UK wholesale review going on, etc. What do you make of that? Is Europe going in the right direction? Is it delivering on the vision, or are we simply creating more complexity?
Thank you, Rainer. I mean, as upcoming presidency, I will not comment on specific measures, just some thoughts, and then I will go to your question. So Anthony has talked a lot about consolidated tape. We begin, as upcoming presidency, to hear a lot of people complaining about the consolidated tape from different perspectives. One common characteristic, they all fear to lose money. So, I mean, in the end, probably the consolidated tape has an interest if people fearing to lose money, losing really money, that money goes to somewhere, and that would be to end investors. Remain to be seen whether that's the case, that would be the case or not. And then John Christian, for sure, depends on how it's framed. So I expect a lot of very interesting discussions within the Council, but second thought, I do not expect at all any discussion of this at ministerial level. So back to my previous point, if you want to make capital markets union backed by a political narrative and political speech, my advice would be not using the consolidated tape as an example. So second point, is there an ability to have a European way of thinking on capital markets, of our view, I mean, because we compare a lot to the US, saying, okay, of course, they have the biggest markets, but that for decades. We talk about UK after the Brexit and so on. When they were within the EU, we didn't talk much about capital markets because it was there, and the other don't talk much about that. We take care of, of course, a bit extreme what I'm saying, but still, I mean, I think there is a place, if I want to be optimistic, to be taken to develop a European way of expertise on capital markets. In this, I mean, a fact that some are beginning to talk about, can we link CMU with sustainable finance, the green agenda, and so on? can be interesting if we can achieve meaningful and pragmatic aspects in that. What I observe, at least in France, through studies also carried out by the French supervisor, AMF, is that more and more people are interested in knowing for what their money is used. So, and especially for the green transition. And I mean, if that helps to lever the financial literacy in that way, that can be interesting. So, I mean, again, I'm back to, can we have a political backing to CMU if we want to achieve something? If we don't, then I'm sure that we will spend months on the consolidated type of debates, but between experts and between competing interests, but in the end, not knowing whether it would be useful or not for developing capital markets in Europe. Back to your question, Rainer. So that means maybe we don't have to copy paste everything that comes from the US, especially if we are not able to copy paste it as efficiently as they've done. First point. Second, what we see is that maybe we do not have to diverge on each topic with the UK. I mean, on the contrary, I mean, if there is a will to say, okay, if the UK says that, then I will say the opposite in the EU. I'm not sure that it will lead to the most efficient result. So when we see what the UK is intending to do with its wholesale market review, probably we need to look at that a little bit more, because it's often said as opposing liquidity and transparency. Yeah, that has some truth for sure. What we see is that the UK wants to remain global, to have remaining global markets. For this is attracting liquidity, is reviewing some EU rules, STO, for instance, whether you think or not, but I mean, it's interesting. And then saying, okay, we want to have more liquid markets, so you develop the markets, and that's the first goal, rather than just saying, okay, between lit and dark, I want to favor lit, and so that lit has a bigger slice, if you want. Let's see, in Europe, I mean, France has always promoted lit market. It's not something that was hidden. So, I mean, we will remain neutral, but the usual way of thinking in France is well known. But it's interesting to think again whether we want to have lit markets on a small piece of cake, or if you want to have lit markets on a large piece of cake. And back to what I said, you need to have more capital, you need to have more investors active in that. And if we oppose, I mean, lit and dark with the results that no one understands, so maybe back to what Anthony said about complexity, and no trust in that, then that's an issue. So, I mean, all in all, we all know that there will remain big actors in financial markets. We want to have more smaller investors, even retail, active on markets. We have to make them work in a way together. Lit markets are useful in that regard, for sure. Transparency rules are very important. But if there are ways not to make that opposing and to remain on something pure, but very small, maybe we would gain a lot and then ease the competing views. Because if there are more capital, I'm sure that there are more money for financial intermediates in the end to share. So let's see, but that would be my general comment, and look carefully at what the UK is doing. After all, they are not that bad and they are quite clever. So
Absolutely. No, thank you.
Can I react
Yeah.
very quickly? And
I
Sebastian, I think, yeah.
let me maybe just probably give you the floor, but maybe specifically ask on the to rebut a little bit on the consolidated tape, because when I look at it, and Anthony, you're probably good to answer that. If I look to the US, there is a mandatory contribution, what we're going to have in Europe. So exchanges need to give their data. And then there's a system where exchanges are compensated for basically transparency for the lit market. Now, and there's a clear use case, best execution, and that's maybe the question we need to ask Christiane afterwards. So I think in the US, it's very clear what goes in, what comes out. How do you see that sort of in the European proposal, and what would be sort of your reply to what Sebastian said as a vision, what the tape should have?
Yeah, I mean, the first comment I'd like to make is that when the first serious discussions took place about the tape many years ago, I remember a discussion with buy-side firms and asset management firms that have real clients, institutional clients and retail clients, and they were showing us the market data bill every month, which they considered as being not only too high but also growing every month without any particular reason. And it was not bills that were coming from the exchanges, because we actually sell our data to people who rebroadcast it. It was bills coming from larger data vendors such as Bloomberg, for instance, or Refinitiv. And they bundle the data that we sell with other added value data. They already have a pretty complete view of the market, if you want. They already have some form of a tape, and they add data, information, messages, indices, etc. And these large data vendors are key for the functioning of our market. That is true, but they are outside any kind of regulation. And for sure, they are outside any kind of European regulation, because most of them are US based or non-EU based. Fast forward today, the project that is as it is expressed about the tape doesn't touch these guys in the sense where they can't be touched by EU regulation, and creates requirements that are so out of touch that the only people who will be able to reply with a valid technology solution that is not loss-making from a financing point of view are actually the same actors, the same entities that we were complaining about initially. And so it's going to be the Bloomberg of this world who will be able to offer the CTP as it is expressed today in the text. So this is absurd. It's completely absurd. My second comment is about stock exchanges. There are truly two kind of business models within stock exchanges today. One is about large global exchanges work mainly on derivatives and post-trade, but mainly derivatives who are pretty much organizing key markets, but for professionals. And the other ones are exchanges who are closer to the initial role of an exchange, which is to finance the economy, and hence helping SMEs to raise monies, and making sure that you have a diverse pool of investors. And obviously, this is where Euronext stands today. And so our business model is designed in a way that we invest continuously on segments of the market, such as SMEs, SME financing, IPOs, smaller indices, and of course the reach to retail and institutional investors, and that is what's the Sebastian, you refer to the fear of losing money, but this is how we use the money we earn from data. And so if we earn less money from data, we will have less ground to continue developing the capital market union. So I'm not saying this is going to happen. What I'm saying is that we should look at the bigger picture. And the third comment is about the US. I often show a chart I call the spaghetti ball, where we compare the market structure in Europe and in the US, where you see true competition in the US between trading platforms and pure trading venues, and it's a very intense competition, as Rainer mentioned, with low margin. But you only have one clearinghouse and one central securities depository who manage the post-trade chain. The post-trade chain in the sense of the guarantee and the settlement functions. In Europe, we have an extremely complex environment on clearinghouses and on central securities depository. We have 30 CSDs, and which has been created by this regulatory complexity and the competing provisions of different directives and regulations such as MiFID and CSDR, EMIR, MiFIR, etc. And the result is that it is extremely difficult today to have the true cost of trading and to be transparent there because of this complexity that does not exist in the US. And so the tape in the US has been designed for a specific layer, which is a competition between exchanges. But transposing it into Europe makes no sense because it is not the same regulatory environment, and there are a lot of different cost base that can't be ignored. Now to try and answer Rainer's question, and I'm sorry because I'm too long. We believe that if we want the tape to be to work in favor of transparency, everyone needs to contribute, not just the lead venues for sure. And so how we're going to do that, I don't know. And I think there is a challenge, a technology challenge for the tape, which is to gather all the feeds, and then you have hundreds of them, to standardize the data and to redistribute it in a way that is efficient and that has an impact. How we're going to do that from a solution point of view and from a business model point of view, I don't know.
Christiane, Sebastian had the idea that maybe the money can be redistributed to the end investor. That's always a good idea. Are you already counting on the money you will receive from the consolidated tape? What would be the benefits you expect? And maybe you can talk a little bit about best execution.
Yes, but before I speak about consolidated tape again in a bit more in depth, and where we see as retail investors the benefits and the detriments, let me just go back to comments that have been made by Sebastian and Anthony on lit and dark trading venues. I'm not at all against dark trading. There is for dark places. There's also a business case for larger orders, etc. In my view is a problem is, and I think Anthony pointed to this, is this extreme fragmentation of the EU equity market. And what I think is that this fragmentation has also facilitated the rise of practices such as payment for order flows, which especially target non-professional retail trades. And Anthony and Sebastian, you both have pointed out that the share of investors has increased significantly most recently. We see the same in Germany. We see especially that the participation of young people investing in the stock markets increased in 2020 by 67%. I mean, that's incredible. That's the highest increase we have ever seen, especially among younger people. And one or the major reason for that was the cheap and easy access to stock markets through these online or so-called neo-brokers. And of course, this, as a retail investor representative, this increased participation is really positive. But there I come to market structure. What we do not know is whether this payment for order flow business model is beneficial in the end for the individual investors. We don't know anything about the market makers behind the brokers. They pay money for the retail order flow, but what do they get in return? They are not philanthropes, of course. And in the US, we know there is rules 606 from the SEC. There we know it is $1 billion business for trading firms. These figures are public, but in Europe, on the contrary, investors have no clue about the amounts of money flowing between the brokerage firms and the players behind. We do not know even through which trading venues retail orders sometimes are routed. And most importantly, what we do not know is if such trades are executed on terms most favorable to clients or most profitable to the brokers. That is one good thing in the Commission proposal, the ban of payment for order flow, especially with the reasoning provided by the Commission, which said that it wanted to enhance pre-trade transparency and increase execution quality for retail investors. So this sounds really good at first sight. But I'm not so sure if this proposal really will pass the Parliament. There are already some MEPs that have loudly voiced their concern. But what I think it is really important that we have now a true discussion about payment for order flow, which I, however, somewhat would like to see being extended to other inducements, because there we have a total divergence among member states whether inducements are allowed or banned. And here I think a lot more of transparency is needed. Then another point, Sebastian, you said, can we have a political backing for the CMU? I think we need the political backing. The CMU is the hugest project. It started with just a rather small target, create investment opportunities for firms and investors. Then we had Brexit. Then we had, as you rightly referred to, the green financing, sustainability. We have now the COVID crisis, which is also included in the CMU package. So we have the Commission has created, I don't want to say a monster because it does sound too negative, but it has created a huge, like a mountain, and I'm not sure if this project is becoming too big. I hope it has become too big to fail. But let's see where we move on this project. In any case, what we really need to do is we need to reduce, Anthony, you said that, access hurdles. We need to reduce these hurdles. We need simplification, and we need reduction of complexity. I'm not sure if regulation always leads to more complexity, but for that we really need a holistic approach to make sure that we look at the whole market as such, and don't work on a silo approach. And now, Rainer, if I still have time, 2 minutes, I will just
Briefly,
go back
yeah.
to the consolidated tape, but I could not stop myself. I'm very sorry.
Yeah. Sure.
So what do we want on the consolidated tape? In principle, for me, I'm not the deepest, I have not the deepest knowledge on consolidated tape. I'm not from a stock exchange. I'm a retail investor representative. But what I see is you have the opportunity of a consolidated tape for pre-trade information or for post-trade information. There you have various different options, 50 minutes delay, and blah, blah, blah. But these two options, in principle, you have. For me, a real-time tape containing pre-trade information may create an ecosystem that is ripe for arbitrage to the detriment of retail investors. It would make it increasingly difficult to take steps to ensure that retail investors get a good deal from European public capital markets. What for me matters most is that individual investors can ex post easily and freely check their order, that it has been executed in the best of their interest. So for me, the use case is for a CT that individual investors are enabled to evaluate best execution on their orders. Ex post is key. There are risks to citizens, as I said, of including pre-trade information. Therefore, all retail orders must be in a post-trade CT must be precisely timestamped, traceable, and include information on the precise market venues on which the order was executed. So that, for me, is key.
So, I mean, maybe Sebastian, I'll give you the word for a little bit. You heard, I think there's commitment from Anthony and Christiane to the CMU and holistic vision, I think to support company financing and to get the best deal for end investors. But I think when I hear both, you know, they doubt, and I think Anthony used the word underwhelming for the proposal. They doubted a little bit that the additional complexity we see coming without that clear direction and vision to probably deliver at the end for end investors. So a little bit your view, how can we get that backing? How can we create a vision? Is that something the new presidency needs to take on? Is that something?
No, that's part of, the presidency job. On the one hand, to serve as another broker, to make progress towards consent within the council on texts, legislative proposals, of course, to ensure negotiations, trialogues, but it also serves to give political impulse within the council, for ECOFIN meetings, informal ECOFIN especially, but also Euro Summit. And I think Capital Markets Union is like banking union. It has become kind of a gimmick. So you have the word union, it's perfect. But what does that mean concretely? So thank you, Christian, thank you, Anthony, for supporting. For saying that it's a need to have a political backing. I would, of course, agree. It's more about how can we have it. Again, it's not about discussing this or that, even a measure, even if it's very important for financial actors, like consolidated tape. I will never have a ministerial discussion about consolidated tape. That's for sure. So when you think of Capital Markets Union, you have three words. The first one, right now, in my view, is the most important. We need capital to finance investment in European transition, in European future, in European growth. That's political. Having said that, I have not said much. You need, of course, concrete things after that. But still, when you see Solvency II revision, when you have LTIF, when you expect a retail investment strategy, you can think of objective rather than saying, okay, I've put a proposal on the table for the Commission. I've reached a general approach within the Council. That's for the presidency. And for the Parliament, okay, I've made my amendments and I've got a deal in plenary. That's for rapporteurs. Yeah, but for what? What is the result? Is that better or not? So, kind of simple KPI saying, does that serve the goal to have more capital? First point. Second point, more capital that we can channel to long-term needs as fight against climate change, or equity needed to invest in digitization, etc., etc. That speaks to the political level, at least in France, but I have the feeling also in other member states. And when I look at the German coalition agreement, I find some of that. So, let's try to have that as the fitness check of whether for all regulation, all legislative text, we are going into the right direction. Just one last word. We know that we will need a lot of money. We have achieved much progress during the crisis, COVID crisis, public level, we had NextGen. I mean, 2 or 3 years ago, it was just unthinkable. But we all know also that it will be quite difficult on the one hand to make as fast as last year on such movement from the public side. Second, that public money is also in limited amount. So it's not magical, as some say. And so that we need private money. That's as basic as it is. But money and savings belong to savers. So we have to put a framework which is incentive for such savers to put their money aligned with the common interest of promoting growth, sustainable growth in Europe. So that's where I say we have much work to do and to find the right balance. It's helped if we stick also with a global goal that we can frequently monitor quantitatively. So that's why I'm really thinking that KPI, but simple one, not too many, which can be monitored at political level, could be important and at least will also testify of a political commitment, a genuine one, and so help to build political backing, political narrative, virtuous circle in that regard.
No, I think, thank you very much, Sebastian. I think if you mentioned KPI, I think we proposed 5 years ago to look at market capitalization to GDP as FESE, and I think I'm very happy to see that the European Commission now has picked up and is actually doing various KPIs, so I think that's good work. I think you've heard from the exchanges that we're, I think, highly committed to the vision of delivering a capital market union, that I think we do a lot every day by catering and nourishing IPOs and trying to serve investors well. I think our fear is actually that we are not delivering for the end investor what he deserves in terms of transparency, in terms of being able to verify best execution. And those were a little bit the demands we heard from Christiane, but that I think we're increasing complexity that will benefit some actors, but not the end investors. So I think that's the fear that we have. So I think we hope, the political vision and the clear KPIs that at the end deliver for end investors are really, that will be the outcome of the MiFIR review. And certainly, I think will deliver for the retirement of European citizens. And I think that's where we all are probably keenly interested in. That brings me to thank my panel. We're slightly over time, and I would turn for the closing remarks to someone who I think can speak very, very probably eloquently on the topic of retirement. Guillaume Prache, the closing remarks, the word is yours. Thank you very much.
Much better. So thank you very much again. Sorry for this technical mishap. And thanks to FESE to give me, as a representative of financial users, the opportunity to make some closing remarks. And I think you will agree with me that we had a very enlightening debate on how equity markets, bond markets as well, structures linked to pension. And that is a workshop during this first European Retirement Week. And pension adequacy is certainly the second biggest issue facing financial users next to sustainability. As first comment, as Rosa and Christiane earlier talked about the returns of long-term investment and pension products for the people, for European people. Indeed, they too often perform very poorly or even being negative sometimes, despite overall bull capital markets. Equity and bond markets over the last 20 years, the performance overall is very high. And only very few, in fact, come close to this capital market performance, which is what equity markets provide. And that is, in addition, despite, I think Sébastien talked about the loss aversion of people. He's right, huh? We are loss averse, and you are all loss averse. Why would we like losses? The problem is pension providers and insurers are even more loss averse than you and me. And the proof is we are being now pushed to long-term products where the investment risk is being shifted to us. So in occupational pensions, there is a push from defined benefit plans to defined contribution plans. And in the personal pension area, there is a push from capital guaranteed insurance product to what is called unit-linked product, where, again, the investment risk is for us. So whether we like it or not, we are more and more exposed to capital market risk. And that's also, of course, because of financial repression. So we do need a much more and better access to simple and more cost-efficient products, such as the ones proposed by the markets, low-cost index ETFs, exchange-traded funds, listed stocks and bonds. And that is really crucial to empower retail investors and to complete the capital markets union for Europe. And this currently we don't have. I give you two very striking examples. If you compare the upcoming PEP, Pan-European Personal Pension, versus, for example, the US investment individual retirement account, IRA, the IRA is much more simple. The basic PEP is not simple. And the IRA is open to direct investments into low-cost index ETFs, listed equities and bonds. This is a missed opportunity of the PEP that I hope will be corrected with the current retail investment strategy launched by the European Commission. And as we have a high-level representative of the French Minister of Finance, I would give a second example, also on personal pension. Again, the US IRA, but versus not the PEP, but the PER, the new personal retirement pension retirement product from France. It's simpler than the basic PEP, but I'm not sure also you can directly invest into ETFs and shares and bonds, but more importantly, it's 3 times more expensive than the PEP basic option at 1%. There is a recent CCSF, which is a public body in France, that issued a report with such figures for the PER. And that's because of commissions on underlying funds. And that eventually 2% more costs cuts your pensions in half. So that's why we very much welcome steps towards reducing this commission problem and the bias in advice. And we welcome and we salute the prohibition proposed by the Commission for the on payment for order flow. Of course, as you know, payment for order flow should be read payment for retail order flow. They would not be paying anything for professional orders, of course. So that's a very good and courageous first step from the Commission to ensure bias-free advice. And when I say that, I'm quoting one of the 4 top priorities of the Commission in this retail investor strategy that has been launched recently. And that is why, beyond prohibiting payment for order flow, by the way, it's only a proposal from the Commission for now. It remains to be seen if it will pass the hurdle of the Council and the Parliament. That's why also we support a very moderate and first step proposal that goes beyond, and that would be a step towards bias-free advice for all retail investors. It's the proposal made not by us, but by an industry-dominated body called the High-Level Forum for the Capital Market Union that was set up last year by the Commission, and just proposes to extend the limited restrictions to inducements, that is the technical word, to commissions, to kickback, as the chair of EIOPA, used to say, from MiFID to the other retail investment products, especially insurance-based products and personal pensions, and to ban execution-only inducements on execution-only transactions, which happen a lot from retail investors into capital market, because by their own name, execution-only transactions do not include any advice. But beyond payment for order flow and beyond biased advice, retail investors should also be given a fair outcome. That is what is called best execution in EU law, that you discussed at the panel, that you discussed in the in the first speeches. And currently, market structures do not deliver the best execution, best outcome for retail investors in the EU, about 50% of trading. I'm going quickly because this has already been said very well by the participants of the panel. About 50% of trading is nowadays taking place in the dark. And we need, as retail investors, we need capital market venues that are fully transparent and that ensure the adequate price discovery information mechanism. Therefore, the step beyond that the Commission should take is not to allow that retail flows goes directly or indirectly to the dark venues, especially the biggest ones called systematic internalizers, who for us act as free riders. And let's have dark venues going back to their roots. At the beginning, they had been authorized to handle large-in-scale transactions. By definition, large-in-scale transactions are not retail orders, but nowadays they do. It is a demand from Better Finance since the beginning of the Capital Market Union in our briefing paper from 2015. Last word on the consolidated tape. I'm a bit disappointed this is presented as the silver bullet to reform market structures, because it does not reform market structures. It's something that could be interesting, but of course, as it has been said by panelists, first it's quite a technical issue, especially for retail investors, but it is not obvious that it will provide benefits to retail investors. Maybe a post-trade consolidated tape which stamps very precisely all the steps of the retail orders, from the date stamping, time stamping of the retail order, to check if there has been really best execution or not, because currently it's very difficult for the retail investor, impossible to check that very thoroughly. And it is crucial also that this consolidated tape is fair, easy and cheap access for retail investors, and this I am doubtful that we'll get. But the main point, and I will stop there, is that that by itself will not solve the market structure issues I just mentioned that you discussed at this workshop. And the European Union is really now at a critical moment after the exit of the UK and the biggest equity market there, just trying to leave the health crisis behind and to make Europe resilient, competitive, have more capital, as Sebastian said, for the green transition, etc. The opportunity is great. So let's make it happen, and hopefully the French presidency will be a bold one. Thank you.
I think very fitting words. We need the vision how to deliver for citizens. And I think, as you very rightly pointed out, market structure, giving best execution, focusing on, I think, the end investor is key to this. So we very much hope we will see this vision, how to deliver and how to mobilize capital for, I think, Europe, and how to deliver to the investors at the end. Thank you very much for attending the webinar.